If I had known this earlier, I wouldn't have wasted years, I wouldn't have blown accounts, I would have already been making $800 a day. And right now, I'm going to show you something that will completely change the way you think about trading. No pretty words, no empty motivation, just a clear structure every beginner must start with. This video is your chance not to repeat my mistakes, so don't get distracted for even a second. Okay, I'll start with fundamental information, a simple approach to trading beginning from the basics. Then I'll show you the websites and tools you'll need to go through this process together with me. Next, I'll talk about trading psychology, which is most likely the single most important factor that can either make your trading successful or completely destroy it. I'll explain a simple way to understand trading math, which at first may seem super confusing, and I'll also give you a full express course on the most important things I know about technical analysis. I'll also show you how to create and test your own strategies, and at the end we'll apply everything we learned in a real scenario and see how it works live. So by the time you finish this video, you'll have a clear and simplified plan for how to properly start in trading. First, let's understand how trading works and how we should look at the market. In trading, there are a huge number of small details that can easily confuse you, but only if you study them separately and chaotically. So first, I'm giving you the big picture of how the market functions and what its mechanics look like. Right now I have a chart open, but we won't pay attention to anything except how and why the market moves. When we look at the chart, in this case the blue line, we see price rising and falling. Essentially, this is a visual representation of mass human psychology. There are buyers and there are sellers. In reality, everything is a bit more complicated than just clicking buy or sell. Algorithms, direct orders, and other mechanisms come into play. But the core idea is simple. The market constantly adjusts itself to remove imbalances between supply and demand. It works like this. Take this section of the market. Here, price is moving upward. That means there is buying demand and selling supply. If demand exceeds supply, price will continue rising until it reaches a point where supply once again becomes stronger than demand. After that, the market corrects downward until demand takes over again. And this back and forth movement creates volatility. Simply put, volatility is when market prices actively move up and down, and in those moments we have great opportunities to earn. Put very simply, the trader's job is to find a moment to buy an asset at one price and then sell it at a higher price. For example, you buy 100 units of something at $100, the price rises to $105, you get $5 profit per unit, that's $500. Easy, buy low, sell high, profit. Now let's go one level deeper and figure out where these intraday opportunities come from. This is the key to making money within a single day, exactly what most of us want, fast. To understand this, let's take a 1-year segment. Overall, Bitcoin grew about 70% over the past year, okay? That means if we invested $100 at the beginning of the year, by the end of the year we'd have $175. Technically, our total risk was that if Bitcoin suddenly collapsed to zero, we'd lose our original $100. And in a normal year, you would earn even less. So basically, we'll have to wait an entire year to make those $75, which is actually pretty good if you have a large amount of capital. But if you have a small deposit, a small account, and you want to make a lot and make it fast, it's super hard but realistic, then you need different tools and a different approach. What if we zoom in and take one small segment instead? Instead of a full year, let's look at the price movement for just a single day. Take today, for example. Even in one day, we see a move upward and a move downward. Instead of waiting an entire year, if you entered the market here and sold somewhere here within the same day with the same $100 risk, and I emphasize we risk the same $100, you could have earned plus $185. And that's from just one movement that happened in about an hour. And within one day, there may be several such opportunities, allowing you, instead of earning $75 per year with the same level of risk, to earn $500 to $800 in a single day. But when we trade within the day, everything becomes much more difficult, because you can't earn more and faster with the same level of risk and the same complexity. That just doesn't happen. Here you need exact calculations. You need to know precisely how much you're risking, where you're entering the trade, and what the probabilities are that things will go as planned. Without this, there can be no stable earnings. Now let's talk about the tools and websites we'll need to organize all this and actually start trading. But when we trade inside a day, everything becomes much more complicated. You simply cannot earn more and faster while keeping the same level of risk and the same level of difficulty. No, and this is where not just the idea matters, but precise calculation. You must clearly understand how much you risk, exactly where you enter a trade, and what the actual chances are that everything will go according to plan. Without this, there can be no talk of stable profits at all. Now let's talk about all the tools and websites you'll need to set everything up and actually start trading. In total, you basically need just 3 main pillars. The first one is TradingView, the platform where you work with charts and do all of your analysis. This will be your main workspace. For your convenience, I left a link to the platform and a separate lesson about it in the description. The second pillar is the place where we will actually trade. And even before entering real positions, I'll show you how to practice completely risk-free, but more on that in a moment. We will trade on one of the top global exchanges, Bybit. Right now, you need to register there, pass identity verification and deposit at least $100. That is more than enough to apply everything in practice. If you can handle everything by yourself and it's easy for you, simply register using the link in the description and get up to $30,000 for trading. But if you feel like things are still difficult, then start with the 5 free basic lessons. They have a support team that will answer all your questions if something doesn't work. I left the link in the description, or you can use the QR code. The third pillar is a trading journal. It can be a Google Sheet or any other format you like, even a paper notebook. When you open TradingView, you'll see a screen that looks something like this. You need to click on products at the top and choose super charts. That will open an empty chart. When I trade, I usually do this. I place the TradingView window on one half of the screen and the Bybit window on the other. When you choose a trade, you choose a trading pair, one asset against another. Most often, it's an asset against the US dollar. For example, Sol USD is Solana relative to the dollar. The dollar hardly moves, but Solana can rise or fall, and that movement is what we trade. You can manage your pairs with the watch list in TradingView. For example, if you create a new watch list, click the plus sign and choose, say, cryptocurrencies Solana USDT. This adds different trading pairs to your list, allowing you to switch between them quickly. Now looking at the chart, you'll see that at first you had a line chart enabled. It's just a simple line showing how the price moves. But I can switch to candlesticks, and the reason is that candles give much more information for a day trader. Let me explain how candles work. A green candle shows that the price increased, it opened at the bottom, moved up to the maximum, moved down to the minimum, and closed above the opening price. The candle body is from open to close. The wicks show how far the price moved up and down. A red candle is the opposite. It opened higher, closed lower, so it's red. The price fell. If you feel that charts and candles still seem difficult, pause this video and watch the one I linked. You'll understand everything after that. And then continue watching. It's the best beginner-friendly guide on YouTube for learning charts. But let's get back to our chart. Candles show different information depending on the selected time frame, the time interval. In the top menu, you can choose an interval from 15 seconds to a full week. For example, I have 2 Ethereum charts open side by side for demonstration. On the left, a 5-minute chart, on the right, a daily chart. The same highlighted area appears as one single candle on the daily chart, showing the open, close, high and low of that entire day. But on the 5-minute chart, that same daily area is broken down into the price movement throughout the day in 5-minute increments. A time frame simply shows how much time one candle represents. On a 5-minute chart, one candle equals 5 minutes of movement. On a daily chart, one candle equals one full day. And the smaller the time frame, the shorter the period each candle represents. Now let's move on to trading psychology, and honestly this is the most important aspect. It will either help you grow or completely destroy your results. It determines whether you stay stuck in a loop with no progress or push through challenges and improve your performance. I've highlighted 3 main beliefs you must change in your mindset. After you understand this section, you should have that aha moment where you think, damn, now I finally understand how this works. Only after that can you move on to practicing with real money. Here are the 3 main points. First, you must stop thinking that a loss is always bad. As people, we are used to seeing any loss as a sign that we are not good enough or that we need to fix something to get better results. But in trading, this doesn't apply. You need to simply accept this truth, even if it feels strange at first. You'll understand why a bit later. Second, the belief that being wrong is bad. This is connected to the first point. When we're wrong and lose money, we think we should immediately adjust our behavior. But in trading, this is completely wrong. You need to flip this idea upside down. Third, the misconception that if a trade made money, it was a good trade. Not true at all. Every time we take a trade, only one of 2 outcomes is possible. The price goes up and we make money, or the price goes down and we lose money. It sounds obvious, but how we manage this process determines our actual results. Every time we enter a trade, we must first decide how much we're willing to risk, whether it's a certain percentage of capital or a fixed dollar amount. Let's say we decide to risk $100. This means that if we enter the market here, we must set a stop loss so that if the price drops to a certain level, our loss is limited to $100. This way, we also know that if the price moves upward 3 times the distance of our stop loss, we will make a profit equal to 3 units of our risk. Let's take the same example. We have 1 unit of risk, those $100, and we aim for a potential profit of 3 units. If our prediction is correct, say the asset is now $153 and we want to risk exactly $100 in this trade, what do? We grab a calculator. Entry price $153, stop loss 150, 153 minus 150 equals $3. Now take the $100 we are willing to risk and divide it by 3. We get around 33 units of the asset we can buy. This guarantees that if the price goes against us, we lose exactly $100. This way, we clearly know what to expect, both if the price moves against us or in our favor. And let me say this right away. If all of this feels complicated to you, do not enter the market with real money on your own. Start with basic training, where mentors guide you step by step. You don't even need to pay separately for a trading course. It's already included in the Acme private club. It's an ecosystem with the most relevant crypto market tools, traders, signals, airdrops, yield opportunities, everything for this market phase. Start with a free tour. A real person will show you everything inside, answer your questions, and help you connect all the pieces. Link is in the description or available by the QR code. But now, let's get back to our strategy. Every time we plan to enter a trade, already at the position sizing stage, we must accept that we may be wrong and lose money. To enter the market and open the opportunity to profit, we simply have to accept that we may be wrong. Many people think they must be right every time to make money, but that is 100% not true. Let's say we made 10 trades. We controlled the risk so that each losing trade equals minus 1 unit of risk. 7 trades were losers and 3 were winners. The winning trades made plus 5.2, plus 2.5 and plus 3.1 units. That's a total of plus 10.8 units. Losses total minus 7. Net result plus 3.8. In other words, even losing 70% of the time and winning only 30% with $100 Swiss per trade, we still end up with plus $380. If we approach trading with beliefs like losing is bad or being wrong is bad, we will never put ourselves in situations where we could end up being right and making money. Losses are simply the cost of doing business, the price you pay to participate in the market. Sum total, that's 10.8 units of risk. Losses together, minus 7. And the final result, we end up with plus 3.8. Meaning, even if you lose 70% of the time and win only 30% of the time, with a risk of $100 per trade, you still walk away with $380 in profit. If you approach trading thinking losing is bad or making mistakes is bad, you will never put yourself in situations where you could actually be right and make money. Losses you take are simply the cost of doing business. There's the fee you pay for being in the market. It's important to understand, making money on a trade doesn't automatically make it a good trade. What matters is whether you followed a repeatable process while keeping your risk under control. If you're just jumping in randomly and throwing big money at the market, ask yourself, will this strategy really work long term? Now let's look at a situation where you got lucky and made a huge profit on one trade. In that moment, you're actually standing in a dangerous place, one step away from making a mistake, because that first win was just luck. It all comes down to following the process and understanding exactly what you're doing. These psychological principles and the math behind trading are what actually allow you to succeed. In trading, it's not about being right. The real question is, how much do you make when you're right and how much do you lose when you're wrong? It's all about balance. How often you lose, how much you make on average, and how much you lose on average. If you control your risk and you know your numbers, it becomes very easy to understand whether your strategy works and whether it brings real profit. Now that you understand how to size your positions and why risk control matters, let's move to practice. We open TradingView and look at the market through the lens of technical analysis. There are tons of small details, but I focus on just 4 or 5 that truly matter. Here's a short but variable crash course. Let's open a 5-minute chart. Each candle, 5 minutes of price movement. Here's how I read it. First, I always start by identifying the trend. A trend is simply a stretch of the market where price moves in one direction. If overall it moves up, that's an uptrend. If down, a downtrend. We can figure this out using trend lines. I look for areas where price bounces from some invisible level. Again, it all returns to supply and demand. If I see these key points and draw a line across the lows that price touches, as long as price stays above that line, the uptrend continues. You might notice at some point price finally drops below this trend line, then makes a small bounce and continues falling. This is where the trend flips to a downtrend. Trend lines show the areas where price is likely to pull back and bounce again, and after a breakout, they show the level where price might retest and continue in the opposite direction. We use all of this to build positions with the expectation that price will move strongly in one direction and not break the important level in the other. Since a chart is a visual representation of human behavior, there's another tool that helps, the Fibonacci retracement. Here's how it works. Suppose the chart is moving up. We add the Fibonacci tool from the start of the trend to the highest point. You'll notice when the trend pulls back, it often corrects to around the 50% level, then continues going up. It also often retraces to the 61.8% level, the famous golden ratio seen in nature, shells, trees, even in human facial proportions. And from this level, price often resumes its upward move. We can use these key levels to build our positions. Back to our chart. We identified the uptrend and downtrend. Let's analyze this trend and find important levels. We pull the Fibonacci from the high to the low. As the chart develops, we see price form a low, move up, and sharply bounce down from 61.8%. This troop leads to a strong move down. Another important tool I use in technical analysis is the fair value gap, FVG. You see these gaps everywhere on the chart. These are big candles that create sharp, impulsive moves. I turn on the FVG indicator and it highlights these gaps automatically. Why do I track them? Because price often returns to these zones and makes strong moves from them. For example, here an FVG formed. Price went up, came back to the zone, bounced, and continued upward. Another place, another gap. To spot one manually, you need a sequence of 3 candles whose wicks don't overlap. If the first candle's low and the third candle's high don't touch, that's a bearish FVG. Price will likely fall further. These patterns help us find important entry zones where risk is understandable and at least somewhat predictable. Of course, we only cover the basics. You can't learn everything in one video, but this gives you a solid foundation to start practicing and growing. Now let's move on to the most interesting part, creating a trading strategy and checking whether it really works. Here's the sequence we follow. First, an idea, a concept based on your observations. Maybe you noticed a pattern on the chart. Second, we build a set of rules based on those observations. Third, we evaluate results, how often your expectation happens and what is the average win compared to the average loss. Fourth, we conclude whether the strategy is profitable. Let's take a simple example. You got an idea. We go to Bybit, click the profile icon, open the demo trading mode and test it risk-free. We analyze the chart, set take profit and stop loss, open the position and look at the result. We write everything in the trade journal and evaluate the strategy. You need 10, 20, 30, even 50 sample trades to understand whether the idea is worth it. Again, mistakes are normal, they're necessary. But on the long run, we must end up profitable, only when we're sure the strategy really works, we move to the real account and trade real money. Now, let's say we're confident and want to enter a real trade. We go to Bybit again, choose Sol/USDT and start setting up the trade. 2 types of orders, limit and market. If you want to set your own price, choose limit. If you want to enter instantly, choose market. But for now, we'll use the limit order. First, we calculate our position size for a $100 risk. We subtract the stop loss from the entry, divide 100 by that number, that's our position size. Without leverage, we'd need to buy over 100 Sol at $176, that's around $18,000. Most people don't have that, so we use leverage while still controlling risk. If the stop hits, we lose only $100. If take profit hits, we make around $300. We confirm the order. And this is how you can start with a small account and still aim for meaningful profit, as long as your strategy works and you follow the rules. One winning trade like this can cover 10 losing ones. Even if you get a losing streak later, the overall session stays profitable. You don't have to do anything now, just wait and let the market do its job.